Good evening, everyone. Welcome to our home buyer workshop for Long Beach and Long Beach alumni, as well as open to the public. Really excited for you to join us this evening to talk a little bit about home ownership and kind of helping you along your path towards home ownership. We're going to get started in just a few minutes, but as we get ready, I just want to kind of pull the group here just to kind of see where everybody's at. We have our alumni all across the country, so it's always kind of interesting to hear where people are joining us from. So if you got a quick minute as we get into tonight's class, in the chat, go ahead and put where you're joining us from. So if you're down in LA or Long Beach, or maybe you're up in Sacramento, let us know where you're joining us from. It's always helpful for me as a presenter because I can get a chance to kind of maybe tailor some of tonight's content to where you're joining us from. So go ahead and drop in the chat where you're joining us from. That'd be awesome. And as we get launched into tonight's class, our class is a very interactive session. So when we go through tonight's content, we encourage you ask questions of us. We'll be sure to answer those on air. Anything we can't answer, or if you want to have a one-on-one conversation, we can certainly take it off air, but we encourage that engagement with our audience. So use the Q&A function if you do have questions as we roll through tonight's content. Thanks for putting your comments in the chat, those of you have. So we got some folks from Long Beach, Inglewood, Sacramento, so a lot of Long Beach, Whittier, Nevada City. Okay, cool. Redondo, LA, love it. Okay, so Lancaster. So generally, we're all from California, so fantastic. A lot of what you're going to learn tonight is going to be California specific, especially when it comes to first-time homebuyer programs. So we're going to look at some of that later on in tonight's class. So as we get going for tonight's class, this will run about an hour. So we'll get right up to about 7 o'clock. We'll weave in those questions that you have as part of tonight's content. We have a pretty large audience for tonight's class, so really excited you've chosen on a Wednesday night to join us. A little bit about us. So we're American Pacific Mortgage. We're a proud sponsor of Long Beach State alumni and athletics. So that's why you probably see us on campus. We also partner with other universities across the country. We're based out of Northern California, but we're a nationwide lender. Our team here specializes in education as a leader in homebuyer education. So we're really focused on kind of educating future first-time buyers so they know what resources they have, especially around first-time homebuyer assistance programs. And we do classes like this to help provide them that support. So when they're ready to take those next steps in homeownership, they know they have all the resources and support here to help them along that journey. All right, so here's tonight's talking points. This is agenda for tonight's class. We're going to look at the housing market in just a bit. We're going to do some budget conversations, looking at renting versus buying. We're going to talk about interest rates. What are they doing? When do we expect them to make any changes? We'll talk about credit. We'll then look at student loans and how that can potentially impact qualifying. We'll then move into loan programs. We're going to talk about 5 of the core programs available to you as future home buyers. We'll briefly look at documentation that's typically needed for your starting of your home purchase. We'll also look at first-time home buyer programs. So those of you, well, most of us in this class are joining us from California. So we partner with an organization called CalHFA, the California Housing Finance Agency. There's some exciting new products on the horizon with CalHFA. So we'll dive into that a little bit tonight. And then we'll wrap up tonight's discussion looking at the workflow of buying a house. So if I say, hey, I really think I want to get on this journey towards homeownership, where do I go after this class? We're going to give you the step-by-step process to go from attending a class, getting pre-approved, and then hopefully getting the keys to your house at some point in the near future. And then we'll also talk about a consultation because that's really the design of your home buying package to really help you understand what resources and support you're going to need to help you along this journey. So as we're preparing to take off and work on home ownership, we want to think about, what's this mean to us, right? This is probably going to be the biggest investment you decide to make in your upcoming financial future. So if this is on our goal board for 2024 or 2025, that's all good. But I think it's important to understand what this means to you because, taking the time to do your homework, like attending a class like this, I think is super important. And there comes some really fantastic benefits that go along with owning a home. So you get a chance to create better affordability for yourself. This is an asset. So hopefully that asset will grow over time and that creates equity in your home. So whatever you owe on your house versus what the house is worth, that's called equity. and that appreciates hopefully over time. And then there's some really good tax benefits that still come along with owning a home. So there's been some tax changes over the last several years, but you could still have some tax benefits when it comes to owning a home. So, renting versus buying, totally not an apples to apples comparison. And so when we get into our next segment of tonight's class, it's our budgeting exercise that we always like to launch into our classes. It's called a rent versus buying exercise. And we're going to go ahead and use this tool that's brought to us by Freddie Mac. And we're going to kind of pop over to our screen share here. I'm actually going to screen share this calculator that is used to help kind of support our clients with budgeting. So we're going to walk through this tool. And by the way, all of our material from tonight's class is going to be sent to you via email. So since you've registered for tonight's class, we have all your email contact information. So we'll send that out to you first thing tomorrow morning. But one of the things in the presentation is the link to this calculator. So let's walk through it together as a class. And I want to kind of just show you how this kind of starts up. And then I would encourage you, as a follow-up from tonight's class, get some time to kind of do your own calculations to see what this could look like for you. So the calculator starts off like this. We first of all have a rental amount that we put in. So we'll go ahead and add that. We've already kind of pre-filled some of this just for time purposes tonight. So we have $25.75 as our rent. We expect our renter's insurance to be somewhere around $15 a month. We have expected rental increase over the next year to be 5%. We have now the expected purchase price of my home. So in this scenario, we have $700,000 as our purchase price. Now you're going to learn a little bit more about loan programs in just a bit, but the minimum down payment for a $700,000 purchase price is 3%. So we're going to factor that into our calculator. We have property taxes, which we've estimated about $7,500 on an annualized basis. We have homeowners insurance for the year, and then we have maintenance costs for the year. Okay, so that goes into our calculation for our prospective home ownership. And then we have loan information. So we know that we're going to finance a 97% essentially, right? Because we're going to put 3% down. We have a 30-year fixed mortgage product. And for most first-time buyers, they're probably going to elect a 30-year fixed product. We have our average interest rate. Now, interest rates are a little bit up from this number. They're about 6.5 today, but we have 6.25 for our exercise here. In fact, let's do a quick change on that. Let's make it 6.5 so it's more of a real-time number. And then we have origination charges. Origination charges are what a lender will charge you for their services. Now, for those of you that are part of our partnership network, so Long Beach State alumni, Sac State, some other of our universities that we partner with, you get a discount in our origination charges. So they get discounted by $750. Now, one of the things that's offered to consumers when they decide to purchase to bring down their interest rate is a thing called discount points. And discount points allow you as a buyer to pay additional closing costs to help bring down your interest rate. So let's say, for example, today's rates are 6.5%, but I really want a 6.25% rate. So you as a buyer can pay additional costs to help bring down that interest rate, and that's called points. Usually 1 point equals 1% of my loan amount, and 1 point will equate to a 0.25% reduction in interest rate. Now, all that being said, I don't really recommend discount points right now because unless we have to get to a certain payment level, the return on investment in discount points is not really favorable for the consumer right now, because it takes usually about 2 to 3 years to recoup those investments on discount points. Now, in some cases, it does make sense because the client needs to get to a certain interest rate level for qualifying or achieve a certain monthly payment, or it just makes sense in the overall strategy of the financing. And then we also have in the equation closing costs. Now we categorize these as other settlement services. So you have your lender fees, you have title, you have escrow, you have some charges that maybe the government has. We call those government recording charges, or maybe even transfer taxes for the county that you want to purchase in. And then we have other assumptions in our calculator. So we have our appreciation rate assumption is 4%. We have the expectation that we're going to be in this home for 7 years. And then we have the selling costs of the home. So we have in our calculation, 10% of my future price will be for closing costs as a seller. Now, that's probably a little bit on the high side, but when you sell a home, you're generally responsible for the commissions for the real estate agent that represents you as a seller, along with the agent that represents the buyer, along with other miscellaneous closing costs. And then we have the state and federal tax rate, and then we plugged in a savings rate of 3%. I know some savings rates are closer to 4.5, but for tonight's exercise, we just put in a savings rate of 3%. So what this calculation comes back to us says, well, first of all, let's know our budget, right? So we're at 2,500 roughly in rent. If we decide to purchase, our mortgage payment's going to be about $5,800 a month. Now that's for a $700,000 house, so a big jump up in our rental side of things. We have to, of course, make sure that's going to be affordable for us. But in taking that plunge into home ownership, our opportunity over the course of 7 years is about $35,000 to basically buy instead of rent. Now, how did I get to that figure? Well, it comes along with a big chunk is going to be appreciation of my home going up in value, along with the tax benefits of owning a home. So instead of just paying the landlord every month so the landlord can pay their mortgage payment, now you're taking ownership on your own, using your own funds to help bring down the principal balance of your loan and hopefully realize some appreciation over time. Now, this also should be looked at is that if you're buying in today's market, the loan that you achieve today is probably not going to be like your forever loan, right? Because at times there will be opportunities to refinance your home. And refinancing where you take advantage of a lower rate environment, which many did back in 2020, 2021, to help lower your monthly payment. Now that opportunity may come at some point as a homeowner. So if I'm buying today at 6.5%, doesn't mean I'm not going to have an opportunity to maybe refinance down to 4% or 5% at some point in time. Now, the reality is we probably won't see rates that we saw back in 2020, but certainly, we're a little bit higher than like historical rates across the board. And we're going to learn about that in just a bit. Let's talk now, though, about housing appreciation. As you can imagine, home prices continue to kind of truck along, right? We're not seeing any major drops in housing appreciation or home values. Right now, we have some seasonality working in the markets now, and what that means is we're in the winter months. You can see outside, most of us are facing rain today, right? So, it's not typically your busier buying seasons. That generally will come in spring and summer. So with that said, there's not a lot of homes on the market, but that inventory will pick up as we get closer into the warmer months of the year. Generally, the higher buying activities are in the spring and summer. If we take a look at the past 3 years of home appreciation, you can see kind of this median sales price going up about 9% over the year-over-year look. And then you can see kind of the movement of sales prices here. Now, this is taking a look at kind of the Southern California markets. Now, what's interesting is you look at the 40 days on market as a median. That's telling us that a house, once it hits the market, staying on the market about 40 days, which is a little bit longer than it has been in 6 months back, really, because there's not a lot of inventory out there, but the demand is still pretty strong. So if you kind of go back to your economics 101 class, right? Supply versus demand, limited supply, high demand, that generally will stabilize or increase prices. And so that's kind of what we're seeing in the market right now. It's really interesting as we fast forward into spring and summer. How much are we going to have in terms of inventory for prospective buyers? Because guess what? Buyer activity is pretty strong right now. A lot of people are kind of tuning up their finances, getting ready to purchase, whether it's this year or maybe the following year. And a lot of that buyer behavior is being driven by what's going on with interest rates, right? So this chart kind of looks at interest rates over the last 12 months. This blue line represents your 30-year fixed mortgage, where the green is 15-year. Let's take a kind of a closer look at 30-year fixed mortgages, because as a first-time buyer, that's probably what you're going to be utilizing in your resources. This kind of peak here, the peak of the mountain was in October. I can remember that day. I think it was October 23rd. Rates hit 8%. Obviously, just really changed the landscape of the market. Affordability looked a lot worse. And then we hit that peak, and then we saw interest rates drop. We've been as low as about 6.3 in recent days. Rates have kind of ticked up a little bit in the last couple of days, driven by some stronger than expected employment numbers. But I do think we're kind of past the high rate environment. I think it's a question of not if, but when rates will come down further, because the Federal Reserve will make some adjustments on the federal funds rate. There will not be, from what we see right now, a federal funds rate cut in March. We'll have to see what happens in the next May meeting for the Federal Reserve. but certainly the market is positioned for a lower rate environment. That's only good news for our prospective buyer, especially if you're thinking about buying over the next 3, 6, maybe 10 months. I think it does pose a really great position for our buyers. Now, what that's also going to do, though, lower rate environments, as I mentioned earlier, is also going to create more buyer activity. So even though we're going to have better affordability, there's going to be more competition in the market. And the question mark for us right now is, if I only have so much inventory, but my buyer activity increases, that is going to create a really competitive market and also push prices up. So we got to really be mindful of that as we're on this journey towards homeownership. Let's kind of talk more about interest rates. And interest rates aren't the same for every buyer. It's going to have a lot to do with, first of all, your credit eligibility. We'll look at credit in just a second, but if I'm a 780 score versus a 680 score, that's going to impact what I have offered to me as interest rates. The product that I decide to select, whether it's an FHA loan or a conventional loan, could make a difference. How much do I decide to finance? What my down payment is. So if my down payment is 3% versus 20%, that can make a big difference. And then we learned a little bit earlier about discount points. So if I decide to buy down my interest rate, that of course is going to help influence my interest rate for the positive, but it does increase my out-of-pocket expense. And then finally, the term of my loan that I decide to select can also influence my interest rate. Generally speaking, when I lower the term of my loan, so instead of doing a 30-year loan, I drop down to a 15-year loan, that should generally bring down the cost of my interest rate. Now, as we consult with our clients, we're going to look at different options to see what the best fit is for you in your home buying plan. But it's important to know that you do have options. It's not just necessarily a one size fits all for our buyers. All right, let's talk a little bit about credit. So that was like the number one thing when I just showed you the interest rate slide is credit. So we want to make sure that we can get you in the best possible position in terms of credit. So whether I'm just trying to start credit, or I've had some challenge credit, or I'm like hitting on all cylinders with credit, we want to make sure we can maximize where you're at from a credit score perspective to get the best product options available to you. So I think it's first of all pretty important to understand how the FICO score is calculated. So if we look off to the screen on the right, which is showing you kind of the weighting of credit scores, 15% is going to be how long have I had credit? So the more mature my credit file is, probably the better my credit score is going to be. 20% is going to be how many new accounts am I trying to open in the last 12 to 24 months? And also how many hard inquiries am I trying to get on my credit, because now I'm trying to obtain new credit. As you decide to take the next steps in homeownerships with our team, we only start with a soft credit inquiry, which does not impact your credit score. So that's really important to understand. So if you want to sit down with us for a home buying plan, we only start with a soft credit inquiry. And then 30% is going to be credit utilization. We're specifically looking at revolving credit with the amount owed section. That's looking at your credit limits versus your credit balances. So if I have a $10,000 in credit limits and I have a $5,000 balance, right now I'm at 50% utilization of my credit debts. Now, ideally, we want to be at 10% or less in my credit utilization. Now, I know we're still coming off the holiday season, right? So we still have maybe some higher credit balances, or maybe we booked a trip that we're going to Cabo in the summer, whatever the case may be. So maybe your credit balances are a little bit higher. Maybe they're 70 or 80%. Let's just make it a goal over the next several months to try to get at least below 50% utilization. And if you're already there, then make it the goal to get to 10%, because that's really where we want to get to optimize our credit score. Now, let me give you a quick tip when it comes to managing utilization of credit. Okay. So if you take some time tonight, maybe take a look at one of your credit cards that you have, zero in to the billing cycle date and then the due date. Now, many of you in tonight's class might be in the habit of paying your credit cards on your due date, and there's nothing wrong with that. But what happens is when you pay your credit cards down or completely off on the due date, it's after the billing cycle date. So if you could kind of change up things a little bit, try to pay off your credit cards or pay them down before the end of the billing cycle date. Here's what happens. What it does is when the billing cycle date closes, the credit card issuer is sending out all the information to the credit card or credit agencies. So if you can get in the habit of paying those down or paying those off before the end of your billing cycle date, that's going to help improve your credit score, and as such, hopefully lift your credit score even further. All right, so that's credit utilization. The next section is called payment history, right? Pretty self-explanatory. How have I paid my bills? Now, if I've had some past challenges, those lates are going to be rated as 30-day lates, 60-day lates, and 90-day lates. So the more severe the delinquency, the bigger impact it is to my credit score. What we're looking at from a events perspective, I guess, on your credit reports, if you've had a challenge, those things are going to be really most impactful for you in the most recent 12 to 24 months on your credit score. Now, every loan program has a minimum credit score. So as you can see on screen, if we're an FHA client, we're going to have a minimum score of 580. If we have a conventional loan, 620. For our veterans that have eligibility under the VA product, it's a 620 score. And then what we're going to learn a little bit later is the first-time buyer programs offered through CalHFA. Those have minimum scores of 640. Okay, so every loan program that's offered by a lender, including APM, we're going to have a minimum score attached to that particular product. All right, let's look at other factors around credit score. So other events that could also negatively impact your score would be things like a bankruptcy or a short sale or maybe a foreclosure. Those things will generally stay on your credit report for 7 years. And we're going to learn about that in just a minute. I'll show you a matrix on historical credit. So just something to kind of keep in mind. But when that hits your credit report, it's going to be most impactful in those most recent 12 to 24 months. Okay. We spent some time talking about utilization, so I won't go back through that. But I would encourage you, if you do have some questions about how to better manage that, feel free to drop that into the Q&A. Account closure, that has to do with closing out a credit card and then just eliminating your relationship with the credit card issuer. Now, the problem with doing that, you want to be careful because if you decide to close out a credit account, it does two things. One is when you close that account, it pulls away all the really good history that you've had with that credit card relationship, and that's going to impact your length of credit, by the way. But it also could potentially impact your utilization because now you have one less credit limit that's available to you, and it could skew to the negative, your aggregate limit, therefore raising your utilization and potentially lowering your credit score. So just be careful before you close out any credit accounts. And then in lending, we look at all three bureaus. So there's three agencies available, right? TransUnion, Experian, and Equifax. We always take the middle score of all three bureaus. Now, if I'm applying with my partner, we're going to take the lowest middle score between my partner and I, right? So let me give you an example. If my top score is 760, right? My middle score is 740, my lowest score is 720. That means my middle score is 740 for me, right? However, if my partner is 720, 700, and 680, now the lowest middle score between the two of us is 700. So that's what would impact our rate offering, product offering, and potentially mortgage insurance. So really important to understand that from the kind of the lens of the lender in terms of how we're going to look at things when it comes to credit scores. Now, I know all of you probably have Credit Karma or some other tool that you help manage your credit scores. Keep in mind when you get access to those types of resources, you're looking at a credit card score. It's not necessarily the score that we're going to use from a mortgage perspective, because there's actually three different models. There's credit card, which is used for most consumer monitoring resources. There's auto, and then there's mortgage scoring. So, of course, in our world, we're going to be using the mortgage model. Okay, I'm going to take a quick pause before we go into our matrix. Any questions so far on some of our material? Any questions on credit that I can help answer for the group? Okay. Well, and again, if you have any questions, feel free to drop those in the Q&A. We'll get those answered for you. Now, I want to share with you this matrix around negative items, because we get questions quite a bit from clients that maybe had a past late payment, or maybe an account that's not reporting correctly. This is how long those particular items will stay with you on your credit report. Now, as I mentioned earlier, 12 to 24 months from the most recent event, that's what's going to be the impact to your score. But this is how long it's going to stay with you kind of as a legacy item on your credit report. Okay, let's talk about student loans. I don't think there's one of our students or guests that come to our classes that doesn't have a student loan. So it's probably something that all of us can relate to, right? So I think it's important to understand as a lender, if you're looking to get qualified for your home purchase, how are we going to look at a student loan? And most student loans are in repayment right now. So, back a few months ago when student loans were not active in repayment, it was a little more challenging for us as lenders to evaluate qualifying. But now most student loan companies are reporting the minimum payment to bureaus, so it makes it a little bit easier. At the same time, though, there are calculations that we use for student loans. So if you're in an income-based repayment amount, and so we have our example on screen, if you had $75,000 in student loan debt and your IBR payment is 250, as a lender, that's what we can use for qualifying purposes, right? Now, if you're in forbearance still, or you're back in school and your payments are deferred, then by default, we have to use 1% of the aggregate balances for a conventional loan, 0.5% for an FHA loan. So it's really beneficial if we can use the IBR payment, because generally speaking, that's going to be the lowest payment option for most of our clients. And we walk through this during a consultation with you. So we'll kind of talk through student loans that appear on your credit report and get a good sense of like what your payments are on those, because we do factor those into the overall qualifying. But just as a reminder, forbearances, deferments because you're back in school, as a lender, we still have to count a minimum payment, even though you might not be in active repayment. All right, let's now switch gears. Let's talk about loan programs. I mentioned earlier, we have 5 kind of core loan programs that we always spend some time talking about in our classes. Now, for us as first-time buyers, will all of us be looking into each one of these products? Probably not. But I think it's important for you as you're taking these next steps towards homeownership to understand some of the characteristics of each one of these products. And then, of course, during a consultation, we'll figure out what the best product match is for you. Now, let's first dive into conventional loans, and conventional loans have a minimum down payment of 3%. When you think about a conventional loan, those are Fannie Mae, Freddie Mac loans. So you may hear that in your or see that in your searches. Now, there's different loan levels for Fannie Mae and Freddie Mac loans. So the conforming limit, which by the way gets updated every December of the year, is currently at 766,550. So what that means to us as buyers is that I can purchase a home and finance up to that 766,550 with as little as 3% down. Okay. Now, if I decide to finance more than that level, then my minimum down payment jumps from 3% to 5% on a conventional loan. Conventional loans have a minimum down payment minimum credit score of 620. And that maximum loan amount goes all the way up to 1,149,825. But that is only for high cost of living areas. So I know many of you are joining us from, LA or Orange County. That loan amount would hold true. But if you're in San Bernardino or Riverside County, we would be capped at 766,550. So depending on where you want to purchase, we're going to talk through like what those loan options look like for you with those different loan levels. Now, FHA loans have a lower credit score of 580. They also will go up to those higher loan levels, but there's not a switch up in terms of the down payment. It still remains at 3.5%. FHA has a lower credit score, so you can see there's a little more leniency there from a qualifying perspective. FHA is also going to look at things like past challenges a little bit differently than a conventional loan. It will get more difficult to qualify for a conventional loan the lower my down payment is and the lower my credit score is. And we'll talk more about that in just a minute as we move into mortgage insurance, which will be our next topic on the following slide. And then for our veterans that have served, there's an amazing product offered through the VA. It offers a 0 down payment option, and it's the Veterans Home Loan. Those loans can go basically above $1 million with still a 0 down payment option. If you're a veteran joining us tonight in a class, we'll go do a deeper kind of conversation into the benefits of the VA product, but it's an amazing product that you can also pair together with first-time buyer programs here in the state of California. Minimum credit score on the VA product is a 620. And then if you're thinking about buying in maybe some of the rural areas in California, so let's say you're like, hey, I really want to buy in Joshua Tree, right? That's where I think I want to set up shop. You can buy in Joshua Tree. It's a designated USDA area that allows you in those more rural areas to purchase with 0% down. It does also have a minimum credit score of 620. And there's also higher loan amounts, but like Joshua Tree, the maximum loan amount would be 766,550. So there's 2 kind of big qualifiers for the USDA product. It's location, of course, because it has to be considered rural to meet the USDA parameters. And there's also income qualifying. So if that's a product you're interested in, we can take that kind of offline because there's some kind of specific scenarios based upon household size and income that's really pertinent information for the USDA product. And then the last product, which is not really common for a lot of our first-time buyers, it's the jumbo suite of products. Jumbo loans come into play where I'm deciding to purchase and finance more than one of the loan limits here that you can see on screen. So generally, it's someone that's going to buy, let's say I'm going to buy in Orange County and I need to finance more than 1149, 825. I might seek out a jumbo loan. Assistance programs don't comply with the jumbo loan because with a jumbo loan, it's not under Fannie Mae, Freddie Mac, or FHA. It's kind of a standalone product. It generally requires a minimum down payment of 10%. Now, typically with home buying, you have to save up for closing costs as well as down payment. However, with the jumbo loan, there's another added component to it. You also need to have additional assets for what we call as reserves. And reserves are additional monies that we have left behind after we've contributed our down payment and closing costs. So reserves could be in the form of a 401k, could be my checking account, could be a brokerage account. Usually that reserve requirement is 12 months of my monthly payment. So let's say I have a $6,000 mortgage payment. A 12-month reserve requirement would mean I need $72,000 left behind in my assets. Okay, so one of the big questions that comes up as we consult with clients is, when do I have to pay PMI? If I pay 20% down, do I still have PMI? Or what's it going to cost me if I put 3% down? Because it's a little misleading in a lot of the calculators that you'll see online, especially in Zillow and Redfin. Those are great home search tools, but from a payment perspective, doesn't necessarily give you the greatest kind of visual, if you will, when it comes to building your home buying plan. So let's talk a little bit about PMI. First of all, how it works with conventional loans. So there's various payment options with the conventional loan PMI product, right? You can pay it monthly, and that's what 95% of clients do. They pay it as part of their monthly payment. But you can also split it up between your monthly payment as well as pay some of that up front. Not very common to do that, but is an option. You have single premium, which allows you to basically write a check for the MI, so to speak. So it comes out of your cash out of pocket to buy out the mortgage insurance for the duration of your loan, which doesn't really make a lot of sense because it would probably be better suited for you to put that money more towards maybe more of the down payment. But there's also lender paid mortgage insurance, also not a really common option. What it would do basically is you take your 6.5% rate, and let's say you elevate that to 7.5%. The margin difference in that rate allows a lender to buy out the mortgage insurance. And the reason why the monthly mortgage insurance is the most commonplace because it does have a cancellation option on conventional loans. So when I hit 2 years in my loan and I have 22% equity, I can apply with my mortgage servicer to have my mortgage insurance canceled. Now, here's the big difference in what you're going to see online versus what a real mortgage insurance premium looks like. It's the difference of the factors that make up mortgage insurance. It has to do with credit score. So the higher my credit score is, the better my mortgage insurance, how much my down payment is, and how much I decide to finance. Okay. So here's an example at the bottom of the screen. So if I finance $700,000 and I put the minimum of 3% down for a conventional loan, my mortgage insurance is about $209 a month. Now, many of you may have thought that was going to be $350 or $400 a month. So it's a little more reasonable, especially if I'm in the higher FICO score levels. Now, if I'm at 760, 780, or even 800, that mortgage insurance could be even potentially less. For some buyers that are considered low income housing buyers, that mortgage insurance also gets reduced down. So those are all factors that can help lower the cost of overall mortgage insurance. So really 209 for that large of a purchase price is pretty reasonable. Now on the FHA side of the equation, mortgage insurance looks a little bit different. So there's two forms of mortgage insurance with FHA. There's monthly mortgage insurance, but there's also upfront mortgage insurance. The monthly mortgage insurance gets calculated at 0.55% of the total loan amount. And then on the upfront mortgage insurance, it's a cost that gets added into your amount financed, which is the equivalent of 1.75% of my loan amount. Now, FHA loans do not have a cancellation option. So even if I have plenty of equity in my home, the only way I can remove myself from FHA mortgage insurance is if I decide to refinance into a conventional loan product. So usually the FHA product is kind of going to be a temporary solution. So if a client comes to us and maybe they're just not quite there from a conventional perspective. Maybe it's credit score, or maybe late payments. The FHA is a great temporary tool to help create affordable homeownership, but eventually try to transition into a conventional loan as their equity grows over time. The FHA PMI is going to look a little bit different in the terms of the numbers, right? So if we take the same $700,000 loan amount, and then we factor in the PMI monthly, which is 320 and 83 cents. Now we also have the upfront mortgage insurance. So now you're going to have to add $12,250 on top of your balance. Doesn't affect your cash out of pocket because FHA allows us to finance that for you, but you are going to increase that starting balance to $712,250. So something we want to be mindful of when it comes to selection of an FHA loan. So the big question here is like, why would I kind of consider FHA versus conventional, right? A little higher cost. I have the upfront mortgage insurance. I don't have the cancellation option. And it's really going to be dependent on what makes the most sense for our clients as we do a consultation. FHA is going to be much more lenient credit score wise, maybe late payments. Maybe we're a little overextended. It's really going to give more flexibility. Whereas the conventional loan product, higher credit score minimums, it's going to be a little bit more restrictive the lesser we put down and maybe the lower our credit score is. So, because of those different characteristics, it's going to be up to us to really kind of figure out what's the right fit for you as we have these conversations in designing a home buying plan for you. All right, I'm going to just take a quick pause to see if we have any questions from the audience. Again, if you do have questions, just use the Q&A and I'll get those answered for you the best I can on air. Okay, we had a question that popped in the chat. Okay, I'll just read the scenario online and we'll kind of talk about it as a team and then we'll keep it moving. So, one of our audience members has a scenario where they're looking to purchase a home with friends. How would this affect our access to different loan programs? So, you can purchase with partners, friends, family. That's completely allowed. Depending on which product you look at, occupancy is going to be a big part. So if your friends plan on occupying the property with you, then, and you're first-time buyers, for example, then you could potentially look at first-time buyer product options. So it shouldn't really change for the most part the eligible programs that you have. If you were considering VA, then that might be maybe a little bit of a hurdle, but otherwise it shouldn't be any type of challenge. Okay, so as our clients are getting on the path towards homeownership and maybe thinking about doing a consultation with us for pre-approval, these are the typical documents that we generally ask for from a buyer. So it's usually 2 years of taxes, last couple of years of W-2s, your recent bank statements, and then your last 30 to 60 days of your pay stubs. Now, that's generally for what we call as a W-2 wage earner client. Now, if you're self-employed, it's going to be a little bit more document intensive because depending on how your business is constructed, we may ask for multiple years of taxes or K-1s, a variety of different things that come up for our self-employed borrowers. Now, in this kind of part of the workshop, I like to kind of go through some different what-if scenarios for our clients that may impact you from the employment side or income side of your home buying plan. So one of those scenarios is, or maybe it's more of a misconception, is that a lot of people believe that they have to have 2 years on their job to be eligible for financing. And it's actually not the case. We actually need to verify 2 years of work history and or education. So let's say I graduated from Long Beach State last spring, right? And I've been working for the state since I graduated, but I have less than a year job. That's okay because I can take my time on the job, couple that with maybe my undergrad at Long Beach State. That will suffice for at least the 2 years, right? I'll have more than that. I'll have over 4 years. So that's a way that we can piece together employment history. So it's just a 2-year requirement of employment history and or education. We also see kind of questions around job transfers. So if someone's working at one organization, transfers to another, do they have to stay on that particular job for a certain amount of time before they're eligible for financing? And there is no time requirement. In fact, in some cases, we can use an offer letter to help qualify our clients. So those are options to consider. Now, where the 2-year requirement gets a little more difficult is that if I have dual employment, oftentimes we see this in the healthcare industry. So let's say I'm a registered nurse and I work for multiple healthcare facilities, right? I work 30 hours here, 20 hours in another facility. In that case, to use both streams of income, I do have to show that I've been on both jobs for 2 years in that scenario. Also, the 2-year requirement gets really important around self-employed individuals. So let's say I just started my business last year, right? Until I have 2 years of full tax filings, I can't include that income, unfortunately, in towards the qualifying purposes. But once I have 23 taxes filed and maybe 22 taxes as a self-employed individual, then I would be potentially eligible to use that income. And then if I have side employment, so let's say I work a 40-hour work week job, but I also do Uber on the side, right? If I do want to use the Uber income, I do have to show that I've been doing that simultaneously with my 40-hour work week job. Okay. And then another question popped in the chat, and then I want to talk on one more thing on income, and then we'll kind of move on to our next topic. Question was, my partner is undocumented. I'm a U.S. citizen. What options do we have when looking for a loan? Do you have any suggestions? Um, so if you can apply on your own, of course, that would be the first option. If your partner is undocumented, there is what we call as I-10 loans. So if you don't have a valid social security number, then you can look at those type of loans. If you just have basically a taxpayer ID number. Those are products that are offered kind of more of on a niche basis. We can kind of take that conversation offline and we can talk a little bit more about that if you have some more questions there. The last thing I just wanted to kind of share with you on this slide here is that around supplemental sources of income. And what I mean by that is that if you are looking to apply by yourself, right? So, and you have other sources of income in your household, those other sources cannot be included into your application unless, let's say I have a partner that doesn't want to be on my application. Unless my partner is going to join the application, I cannot count those other sources of income. Okay. And as you probably know, any like cash sources, anything like that, if I have like maybe a side job that doesn't, pay on taxes, for example, then that cannot be used in the qualifying. And then speaking of qualifying, there is a metric that that lenders use to qualify clients, and it's called the debt to income ratio. It's a really simple calculation. It takes into consideration your gross monthly income versus your outgoing expenses. And generally, we don't want that debt to income ratio to be more than 45 to 50% of our total incomes, or our expenses to be more than 45 to 50% of the total income. Here's what that calculation looks like. It takes into consideration my new mortgage payment, right? So principal and interest, my property taxes, my homeowner's insurance. If I put less than 20% down, or I'm doing maybe an FHA product, I have mortgage insurance. And then if I decide to buy maybe a home that's in a planned development or a condo or a townhouse, I probably have HOA expenses. And then I'll also add into the equation any other debts like credit cards, auto payments, and then I divide that by my monthly income. So in this scenario, we have $3,000 in expenses, $8,500 in monthly income. So this particular client's debt to income ratio is 35.29%. Many clients will ask me, like, what should be my debt to income ratio? Generally, we recommend, or most first-time buyers see themselves pretty comfortable around a 33 to 36% debt to income ratio. Now, as we meet with you for your consultation, we're going to show you what your debt to income ratio looks like. The bigger kind of question that I want to ask you when we meet with you is, what's the monthly budget need to look like for you to feel affordable for home buying, right? Because there's two big goals for us in home ownership. Can we create an affordable plan for you? But can we also make sure that's a sustainable plan that you can feel like you can grow in this home comfortably with your finances? Okay. Another question in the chat I want to just put to the group. So, what if we're buying a home with someone who doesn't have any credit history, but we will be helping out with, but they'll be helping out with the payments? So some products will allow a buyer to finance without having a credit score. But for the most part, you are going to have to be on the grid, so to speak, with credit scores. FHA has what they call is a non-traditional credit option. So let's say I have a 700 credit score, but my co-borrower has no credit, right? You can do non-traditional credit with FHA, and you have to verify sources of payment history. Like, let's say I have car insurance, or that I can verify 12 months history, or a cell phone bill, or a gym membership, or rental history. If I can verify for that for 12 months, that can take the place of maybe not having traditional credit. But FHA generally is going to be the only product stream that's going to allow us that kind of option. Okay, the last component to building a home buying plan in tonight's class is really the down payment side. That's probably one of the bigger struggles for most first-time buyers. It's usually either credit, which we talk a lot about, and we've learned a little bit more about in tonight's class, but it's also savings. So have I got enough savings together to purchase my home? So we want to look at, like, what do we typically need to put together from a savings perspective? Well, we have to save up our down payment and our closing costs. We're going to talk about some assistance programs in just a bit, but closing costs can generally be anywhere between 2 to 3% of your sales price. So we want to factor that into the budget. And then, as you learned earlier, the minimum down payment is 3% for a conventional loan, 3.5% for an FHA loan. And so as we document those assets, there's a variety of different things we could use: checking and savings accounts, 401ks, 403bs, IRAs. You just want to consult with a financial or tax advisor before you dip into those assets, because we don't want to create any tax events for yourself. I had a conversation with a client earlier today. They said, "Hey, Jason, should I take out a 401k loan to buy my house?" And in this particular buyer situation, it didn't really make a lot of sense, because when you do a 401k loan, you're taking money out of the market, so to speak. So here's the example I gave to that buyer. If you have $50,000 in a 401k, right? And you take out a loan for $25,000 on a 401k loan. You've taken a loan out against your own asset. However, the 401k administrator pulls that $25,000 out of the market. So you don't get the appreciation of the market. So if the stock market goes up 500 points tomorrow and you've taken out a 401k loan, now you've lost some appreciation in your 401k account. So it can be an option for your home purchase, not necessarily the number one option. And I think hopefully maybe assistance programs can better support a first-time buyer program with, that type of resource. Gift funds can also be used towards your home purchase. That's where a family member can help kind of lean in to help you with your down payment and closing costs. There is no seasoning requirement for a first-time, for a gift funds. Those can be transferred over right away. It just can't be cash. And any assets that I'm going to use as a buyer for my home buying plan, those assets need to be seasoned for at least 60 days if they're my own assets. All right. I want to save some time to go into our assistance programs, just because we are primarily a California audience tonight. So I think it'd be helpful just to kind of talk about some of the new stuff that's coming out in California for first-time buyer programs. So let's go ahead and move into that now. And one of the really great resources that are available to you as first-time buyers in California are first-time buyer assistance programs. As I launched in tonight's class, I mentioned our partnership with CalHFA. CalHFA is the California Housing Finance Agency located here in Sacramento. We happen to be the #1 lender with CalHFA. We provide the most number of assistance programs across the state of California, many of which are for clients that come through workshops just like you're attending tonight. Here's some of the products that are offered under CalHFA. The first program is offered as MyHome Assistance, that provides that minimum down payment that we learned earlier in our product section, 3% towards your conventional loans, 3.5% towards FHA products. Those are low interest loans that the state give you at a 1% for the down payment resource. It's all deferred, so you don't have to pay back the assistance until you either decide to sell your home or if you decide to refinance in the future. Those products are available right now. There's also a closing cost assistance program that provides up to 2 to 3% of your loan amount in assistance. That resource is a 0% interest product, does not need to get paid back until you sell or if you refinance in the future. So another great tool for you. Now, I will have to say the ZIP assistance program comes with it a higher interest rate for the first mortgage. We're still in a relatively high interest rate environment, so it doesn't always make sense to add on ZIP assistance. The MyHome Assistance product would be your first selection under first-time buyer assistance. And then if you need additional support, we can add on the ZIP assistance program. And then many of you have maybe seen some of our posts on our social channels, or maybe some of our YouTube videos, or maybe you're just seeing this in your searches or on the news, is the California Dream for All program, also known as DFA. There's a second version of Dream for All coming out in April or May of 2024. We've been taking on a lot of new clients that are interested in looking at their options here. The pre-approval are open right now for pre-approval. We're meeting with clients for that program. However, it does not launch until April or May. And what Dream for All does is it provides up to 20% or $150,000 towards your home purchase. Different than the MyHome and ZIP Assistance Program, Dream for All is a shared appreciation program. And we're not going to dive too much into the shared appreciation tonight, but if you do have time, I would encourage you to check out our YouTube channel at J Mada Mortgage. We have a full class that we've taught a couple weeks ago on shared appreciation. I really encourage you to check that out. Super helpful. And of course, if you do a consultation with us, we're going to look at your own individual scenario with Dream for All. With Dream for All, it has slightly lower income limits than the MyHome and ZIP Assistance Program. They're still very favorable for the buyers, but it also has a first generational requirement. And that's really important to understand because the two programs, MyHome and ZIP, have the first time buyer requirement, which only means that I haven't owned a home in the last 3 years. However, with Dream for All, the first generation requirement means that I have not owned a home in the last 7 years, but also that my parents do not currently own a home in the US. So that's a little bit of a different wrinkle with Dream for All. And so not all buyers qualify for that program. So it's really important to understand there's a little kind of tighter qualifying around that product. But we are taking applications on Dream for All now and designing home buying plans and pre-approving clients so they're all prepared for the application window that's expected to open in April or May. And then that is a lottery-based program. I shouldn't mention that. What's going to happen is an application window will be open for 25 to 30 days for Dream for All. Once the window closes, then there'll be a lottery announced. And they're expecting about 20,000 applications across the state for that program. About 17 to 1,800 families will get access to the program. So it's about an 8 to probably just over an 8 to 9% probability for that particular product. These products do have income limits for both the MyHome Assistance Program and Dream for All. We have them on screen here for our Southern California markets. We also have Northern California, obviously, and Central Valley income limits. So they're all across the state of California. So we'll provide those as a follow-up to tonight's class. You can see the Dream for All versus the MyHome Assistance, slightly lower income limits than what you see with the MyHome Assistance. So MyHome Assistance is based upon 150% of the median income for the respective county. And then the Dream for All is slightly lower. It's somewhere in between 120 and 150, depending on the county. I want to walk you through a quick example of how you can apply MyHome Assistance to your first-time home buying plan. So we've talked a lot about a purchase price around $700,000. So if we bought at $700,000, the minimum down payment is 3%. That MyHome Assistance will help kind of offset that. So the only thing I would have out of pocket in this first scenario would basically be my closing costs. Now we can also add on that ZIP Assistance Program if it works for you in your home buying budget. But ultimately, I think the big takeaway here is to be able to say, hey, I don't have maybe the savings to, or I'm not equipped to put down 35 to 42,000, but maybe home ownership's a little bit closer for me if I only had to worry about closing costs. And maybe that's $14,000 to $21,000 because now I've had the resources and support of the MyHome Assistance Program. So many buyers that I meet with throughout the day look at the MyHome Assistance Program, and after they look at kind of the numbers together, like, wow, I can make that happen versus, $35,000 to $40,000 seems like just a big goal, and maybe that's 2 or 3 years out, but maybe I could be a homeowner in 2024 by leveraging first-time homebuyer resources. Here's the eligibility requirements for the MyHome Assistance Program. So it has a minimum score of 640 for the FHA loan, 680 for the conventional product. By the way, just as a side note, the Dream for All program only works with a conventional loan. So that requires that 680 minimum score. Now, for a low-income housing buyer, so if I make less than 80% of the median income, I'm considered low-income housing. That minimum score drops down to a 660 credit score. We have debt to income ratio requirements on all products, 45 to 50%, depending on my credit score. Now, one of kind of the cool things with CalHFA products, the income limits are looking at just the applicant income. And so why that's important, if I kind of flash back to our income limits screen, let me kind of go back a bit. So if I, let's say, want to buy in LA County and I make $190,000 as a household income, right? Now, maybe I only make a 150, but my partner makes 40,000. So that's pushing us over the limits. I could apply with my home on just my income. And if I can qualify for my home purchase based upon the purchase price, right? I could stay within the income limits for the program. Now, a first-time buyer under CalHFA, My Home, is someone that hasn't owned in the last 3 years. Different qualifications for Dream for All, as you just learned. And these products are eligible for any one-unit property. So single-family homes, townhouses, condos, manufactured homes, but manufactured homes have to be on land that you actually own. Okay? So it can't be like a manufactured home that's in a park, for example. Okay, I know I gave you a lot in a short amount of time on the first-time buyer programs, but before we move forward into the 6 steps of home buying, I want to see if there's any questions from our audience. We do get a question in, and let me just answer it on air. Are the first-time buyer payment assistance programs for the Dream for All available to a multi-person purchase of a home, to purchasing a home with 2 other friends, all of us? So yes, you can purchase first-time buyer programs with multiple individuals. On Dream for All, at least one of the buyers must be a first generational meet the first generational requirements. But as long as you plan on all living in the home as your primary residence, you can all apply. But keep in mind, everyone that goes on the application, their income is counted against the income limits. All right, great question. Let's talk about the process of buying a house. So if I leave tonight's class, I want to get connected with us for a consultation, design your own home buying plan. So whether it's a this year goal or a 2 or 3 year goal out, that's totally fine. But get connected with us so you can really understand what your options look like. And the output of a consultation with us is to get pre-approved. And you may have heard about that before. Pre-approval is basically a document that comes out of a consultation. It shows all the design of your home financing, what my purchase price is, how much I finance, what my prospective interest rate is going to be. That's generally valid for 60 days. And for a lot of our buyers, it takes longer than 60 days to find a home. So we can always recertify that pre-approval at any time. Step 2 is going to be the house hunting phase. Now, many of your house hunting starts will begin online, right? You're probably hopping on Zillow or Redfin, and then at some point, you're going to really want to connect with a realtor to help kind of physically go out and see a property. We have preferred realtors across every market in California. So if you want to get connected with a realtor as part of your consultation, we can get you introduced to somebody that can help support you in your home shopping. Now, if I'm out home shopping, I find a couple homes I like, let's say one really piques my interest and I decide to make an offer. Well, that realtor will help you submit that offer to the seller and begin negotiations. If the seller accepts my offer, then I move to step 3. That's called entering escrow. So that means I have an agreement with the seller to purchase my home. The time at which my offer gets accepted to the time I get my keys and I get to celebrate and move in, right? It's about 30 days. We do have a quick close program that we offer to our buyers. It's a 14-day close period, so it shrinks everything down just to make some of our offers a little bit more compelling for the seller and just in general, like competitive, because it is still a very competitive market. But traditionally, the closing of escrow time period is usually 30 days. Now, what happens at step 3 with the offer being accepted? Well, first of all, we're going to give you a call to schedule your follow-up consultation to let you know what next steps look like. We're going to schedule a video consultation because we want to go through all the numbers, your purchase contract, make sure you understand all your options. Inspections will probably get ordered on your home. We're going to order an appraisal on your house, and we're going to start the overall processing of the loan, which includes delivery of your disclosures for your home financing. Now, within 2 to 3 days of the accepted offer, you're also going to be required to make an earnest money deposit. That's a deposit that counts towards your total out-of-pocket expense. And generally, that deposit is 1 to 2% of your purchase price. Now, what's really important is that deposit is retained by an escrow company while you do your homework on the property. The homework period is called the contingency period. Allows you to get an appraisal done of the house, get the house inspected, get your loan approved in the first 14 to 17 days of your contract period. Now, depending on your escrow time period, those contingency periods may be shorter. Like if you say, hey, I want to do a quick close program for 14 days, those contingency periods may be only 7 days. So it's a lot tighter window because we have to kind of turn a little bit quicker because of the timelines. But the takeaway on contingencies is it allows you to do your homework, but feel protection as a buyer that your deposit is not at risk. So if you decide that you have to cancel because it's not a good match for you, you can do so and get a full refund of your deposit as long as it's in the contingency period. Step 4 is going to be processing and underwriting. That's where we do all the administrative tasks on the loan. We've probably locked in your interest rate by that time. And then step 5 is going to be your approval of your loan. That's probably also about 3/4 of the way through your home buying process. At step 5, you have your loan approval. You've probably reached the end of your contingency period. And you're also going to be delivered to you a final closing disclosure. That gives you a 3-day cooling off period before we get to the very final milestone called closing your loan. At the closing of the loan phase, you do need to physically sign with a notary in person. Everything up to that point can all be done via e-signature, but at closing of a loan, it has to be done in person with a notary. Also, at that milestone, you're going to be delivering your final funds for the closing of your loan. So your deposit will now count towards your out-of-pocket, and then you'll have remaining funds potentially at the end of the escrow time period. That's when you'll either wire in those funds or deliver a cashier's check. Most often it's done with a wiring of funds. And then as the lender, we're going to deliver final funds to the escrow team for your loan financing, as well as any first-time buyer programs you might elect. Those monies get kind of settled up, and then the escrow team will transfer documents to the local county recorder's office. And down there, they record a grant deed to transfer ownership to you, as well as the deed, which is your agreement of the loan for the repayment terms of the loan. And then we get a confirmation back that those documents get recorded. And then at that point, you become the official owner of the home. We get a chance to do like a virtual high five or whatever we do to celebrate. But it's a big deal because now you've been basically you've reached the end of the process, and then you make arrangements with your realtor to get keys to the home, go out and grab your sold sign, tell all your friends, post on your social channels about the big accomplishment, because it's a big deal. Like we launched in tonight's class, it's the biggest investment or purchase you guys are going to make in your upcoming financial futures. So taking time out and joining a class like this, hopefully you felt some value in that, because this is going to be kind of one of those steps that you make in your journey towards home ownership. Now, the next step will be to get connected with us. Now, whether you want to ask a few follow-up questions from tonight's class, maybe a scenario that you want to run by us, we're here to help support you with some of those questions. Now, if you're ready to start your consultation, that's a free service we provide. Now, what you're going to do in advance of the consultation is complete an online application. You're then going to upload some of the required documents to your application. Again, we're only going to do a soft credit check, so you don't have to worry about the impact to your credit score. And then you're going to use our scheduling link to schedule a video or phone call that works best for you in your schedule. And we'll meet with you for 30 minutes to design a home buying plan for you. The plan's going to look a little bit like this. Like, where do I want to purchase? How is my credit impacting my eligibility? What do I have in terms of savings that are going to help me with my home ownership? What's the right product for me? And then as we meet together, we're going to create a plan. And then the output of that plan will hopefully be, if you're ready to be pre-approved, to start now your home search. So that's kind of what the process would look like coming out of tonight's class. Okay, so let me answer a quick question in the Q&A. And that question, and we're going to kind of get wrapped up because we're just at the top of the hour. If someone is a co-signer, does it affect them in their future as a first-time home buyer? If they're a co-signer and they're on the deed for a prospective home, there's two ways we look at it. On Dream for All, yes, because you can't be actively an owner in another property to get eligibility as a first generational for Dream for All. For other programs like MyHome, as long as you have not lived in that home for the last 3 years, then you're still considered a first-time buyer. Okay. Okay. Thanks for joining us. We had somebody that duck out a little bit early. No worries. Okay, we're going to get wrapped here. I just want to share with you a really cool resource called our mobile app. You can start the application right via mobile or desktop, but mobile's a great tool. You can also upload documents, but where a lot of clients use this resource is to calculate payment scenarios. I think it's a really great tool. And I mentioned a little bit earlier about our community partnerships. You're joining us probably because of Long Beach State, and we love our partnerships with alumni and athletics. We also have other partnerships across the country. Even on the East Coast, we teach classes very similar to this. So if you have friends, family, coworkers that think would really enjoy this content, have them check out some of our free classes at mortgageeducate.com. And speaking of that, this is all my contact information. So if you have follow-up questions after tonight, you can always schedule an introductory call. But here's all my contact information. Also, check us out on some of our socials like Instagram. We'll put a lot of great updates on our first-time buyer programs. We can be followed at JMada Mortgage. We have a lot of good, useful content too on our YouTube channel too. Things like the Dream for All workshop that we just taught. And this class will be recorded tonight. It's going to be also up on the YouTube channel as well tomorrow too. So with that said, I know I'm a little bit over our time, but I want to make sure I get you guys all that content. And I do want to keep it open for any questions that you have as follow-up for tonight's class. So any questions from our audience before we wrap up? All right. I think we're good. All right. Thank you so much for joining tonight's class. We hopefully will get connected with you for a future consultation or maybe a future workshop. And we will talk to everyone soon. Have a great night.